Before we begin, please note that the information provided in this video is for educational and informational purposes only and should not be construed as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. We are not financial advisors. Please consult with a licensed financial professional for advice tailored to your specific situation. You're scrolling through your phone late at night and you see it. An ad. It's a guy, probably younger than you, standing in front of a rented Lamborghini. He's talking about financial freedom. He flashes his phone at the camera, showing a chart with a green line rocketing upwards. He says one word that sounds like a secret code: Forex. He claims he's making thousands of dollars a day from his laptop on a beach. And he says for a small fee, he can teach you his secret strategy. A little voice in your head whispers, "Is this real? Could this be my ticket?" But a louder, more rational voice screams, "This has to be a scam." That conflict, that confusion, is the exact reason we're here today. Because you're right to be skeptical, but you're also right to be curious. The foreign exchange market, or Forex, is the single largest financial market on the planet. It's not even close. The New York Stock Exchange, the biggest stock market in the world, trades around $200 billion a day. The Forex market? It trades over $7.5 trillion every single day. That's not a typo. Trillion with a T. It's the lifeblood of the global economy. Every time you buy a product made in another country or travel abroad, you are participating in the Forex market. It is profoundly, undeniably legitimate. So, here's the billion-dollar question. If this market is so massive, so essential, and so real, why does it feel so sketchy when you hear about it in the United States? Why does it feel like a minefield of scams and false promises? Is Forex trading even legal for the average American to get involved in? The answer is a definitive, resounding yes, but it comes with a giant asterisk. An asterisk so big it could block out the sun. And in this presentation, we are going to dissect that asterisk. We are going to give you the complete American playbook for understanding the Forex market. We're not here to sell you a course or a dream. We're here to give you clarity. By the end of this video, you will understand the specific, and I mean specific, US laws that govern Forex trading. You will know the names of the government agencies whose entire job is to protect you, and how to use their free tools to your advantage. You will learn the critical, non-negotiable differences between a legitimate, US-regulated broker and a dangerous offshore operation that could vanish with your money overnight. And most importantly, you will be equipped with a powerful set of red flags to instantly spot the scams that are specifically designed to target hopeful Americans just like you. This isn't just information, it's a shield. Because let's be honest, the internet is the Wild West. You've got self-proclaimed gurus peddling foolproof signals, robots that supposedly print money while you sleep, and account managers promising impossible returns. They prey on a very real, very human desire for a better life. They use the complexity of the market as a weapon against you, making you feel like you need their secret knowledge to succeed. The truth is, you don't need their secrets. You need the facts. And the facts begin with a story about why the United States is one of the strictest, most regulated places in the world to trade Forex. To understand the rules today, you have to understand the chaos that came before. Picture the early 2000s. The internet is booming. Online trading is exploding. And in the world of Forex, it was a free-for-all. Brokers could pop up overnight, based anywhere in the world, make incredible claims, and offer insane amounts of leverage. We're talking 400 to 1, 500 to 1. That meant for every $1 in your account, you could control $500 in the market. It sounds amazing, right? A tiny account could potentially make huge profits. But it also meant that a tiny market movement in the wrong direction could instantly wipe out your entire account. And it did. Constantly. There was very little oversight. Many of these firms were operating from countries with lax regulations. If you had a problem, if your money disappeared, who were you going to call? A regulator in a tiny island nation you couldn't find on a map? It was a recipe for disaster, and countless Americans lost their savings to unscrupulous, unregulated companies. Then 2008 happened. The global financial crisis sent shockwaves through the entire system. In its wake, the US government decided, never again. They passed a sweeping piece of legislation called the Dodd-Frank Wall Street Reform and Consumer Protection Act. You've probably heard the name, but you might not know what it did for Forex. Dodd-Frank was a hammer, and it came down hard on the retail Forex industry in the United States. It basically built a wall around the country and said, if you want to do business with American citizens, you have to play by our rules. And our rules are going to be the toughest in the world. This single act of Congress completely changed the game. It introduced strict new requirements for any company wanting to offer Forex trading to retail clients in the US. This is where the alphabet soup of government agencies comes in. And I need you to remember these two acronyms, because they are your single greatest allies. CFTC and NFA. First, let's talk about the big boss, the CFTC. That stands for the Commodity Futures Trading Commission. This is a powerful, independent agency of the United States government. Think of them as the federal police for the derivatives markets, which includes Forex. They write the rules. They set the standards. They have the power to levy massive fines, shut companies down, and even bring criminal charges against bad actors. Their mandate, their entire reason for existing, is to protect the public from fraud, manipulation, and abusive practices. They are not a private club. They are the US government, and they do not mess around. Under the Dodd-Frank Act, the CFTC was given direct authority to regulate retail Forex dealers. They created a set of rules specifically for the US market. For example, they capped the amount of leverage a broker can offer to US clients. While brokers in other parts of the world might offer you that risky 500 to 1 leverage in the United States, it's capped at 50 to 1 for major currency pairs. The CFTC did this deliberately to protect you, the retail trader, from blowing up your account with one bad trade. They also instituted rules about how brokers must hold your funds, requiring them to be kept in segregated accounts at top-tier banks, so the broker can't just use your money for their own operating expenses. So, the CFTC is the lawmaker, the top cop. But who are the boots on the ground? Who handles the day-to-day enforcement and registration? That's the second acronym, the NFA, the National Futures Association. The NFA is the self-regulatory organization for the US derivatives industry. Now, don't let the term self-regulatory fool you. They have been authorized by the CFTC to handle the frontline duties. Every single firm and individual who wants to conduct Forex business with the US public must be registered with and a member of the NFA. There are no exceptions. It is the law. Think of it like this: if you want to be a doctor, you have to be licensed by a medical board. If you want to be a Forex broker in the US, you have to be registered with the NFA. So what does this mean for you? It means you have an incredibly powerful tool at your disposal right now for free. The NFA maintains a public online database called BASIC. That stands for Background Affiliation Status Information Center. Before you ever even think about sending a single dollar to a company, you can go to the NFA's website, type in the name of the firm or the individual, and instantly see if they are registered. You can see their entire regulatory history. Have they been fined? Have they had complaints filed against them? Are they even legally allowed to operate in the United States? This is not a suggestion. This is your first, most critical step. If a broker is not registered with the CFTC and a member of the NFA, they are operating illegally in the United States. Period. End of story. It doesn't matter how fancy their website is, what promises they make, or what some guy on YouTube tells you. If they are not in that database you run, these regulations, the capital requirements, the leverage caps, the registration process, are what make the US market so different. It's expensive and difficult for a broker to become regulated here. They have to maintain a minimum of $20 million in capital just to operate, a rule designed to ensure they can meet their financial obligations to customers. This barrier to entry is intentional. It's designed to weed out the small, unstable, and fraudulent operators, leaving only the most well-capitalized and serious firms. So we've established the who, the CFTC and the NFA, and the why, the chaos of the past leading to the strict regulations of today. The system is in place. Forex trading is absolutely legit in the USA, but only when done through a firm that respects and abides by this system. But the real question is, how do you use this knowledge in the real world? How do you spot the difference between a broker that's playing by these strict American rules and one that's a cleverly disguised trap set up in some remote island nation, using a slick website to lure you in? How do they try to trick you? And what are the specific phrases and tactics they use? That is the practical street-smart knowledge we're diving into next. The first and most critical thing to understand is where the trap is located. It's almost never in the United States. It's on a tiny island you've barely heard of, St. Vincent and the Grenadines, the Marshall Islands, Vanuatu. These places have become havens for what we call offshore, unregulated brokers. They set up shop there for one reason: the rules are weak or non-existent. This allows them to offer things that are strictly illegal for brokers who are regulated in the US. The first lure they dangle is almost always the same: insane leverage. You'll see websites screaming trade with 1001 leverage, or even 2001. To a new trader, this sounds incredible. It sounds like you can take a tiny amount of money, say $100, and control a $100,000 position in the market. It's the ultimate get-rich-quick fantasy. But here's the reality. In the United States, the legal leverage limit for major currency pairs is capped at 50 to 1. That's not a random number. It wasn't chosen to limit your potential. It was chosen to protect you. Financial regulators in the US looked at the data and saw that extreme leverage is the single fastest way for a retail trader to blow up their account. A tiny market move against you, a move of just a fraction of a percent, can trigger a margin call and wipe out your entire investment instantly. These offshore brokers aren't offering you a tool. They're handing you a self-destruct button and telling you it's a rocket ship. The next piece of bait is the deposit bonus. It's everywhere. Deposit $500, we'll give you $500 free. Or, get a 200% welcome bonus. This feels like free money. Feels like they're investing in your success. They are not. Buried deep in their 40-page terms and conditions, which nobody ever reads, is a clause that essentially makes this bonus money a poison pill. It will say you cannot withdraw any of your funds, not your original deposit, not your bonus, not your profits, until you have traded an impossible volume. Something like, for every $1 of bonus, you must trade $10,000 in volume. To withdraw that $500 bonus, you need to trade $5 million. It's a mathematical trap designed to lock your money in their system forever. A legitimate, US-regulated broker is strictly forbidden from offering these kinds of deposit bonuses for this exact reason. They are considered a deceptive marketing practice. Now let's talk about the website itself. The modern scam isn't a poorly spelled email anymore. It's a slick, professional-looking website with stock photos of smiling, diverse people staring confidently at charts. They'll be plastered with awards. Best Broker in Asia 2022. Most Trusted Platform in the Middle East. These awards are almost always fake. They're either purchased from bogus award companies or completely invented. There's no Global Forex Awards Committee handing these things out from a skyscraper in Geneva. It's a guy who owns a website, and for a few $1,000s, he'll send you a PNG file of a golden laurel wreath you can put on your homepage. Then come the testimonials. You'll see Sarah from Ohio, who says, "I finally quit my job thanks to this platform," with a picture of a happy woman on a beach. A quick reverse image search often reveals that Sarah from Ohio is actually a stock photo model, and her picture has been used to sell everything from dental insurance to retirement homes. And the pressure is always on. You'll see countdown timers ticking down. Special 150% bonus ends in 2 hours. You'll see pop-ups that say, "Alex from Texas just made a $2,300 profit on gold." This is all designed to trigger your FOMO, your fear of missing out. They want you to act emotionally, to deposit money quickly before your rational brain has a chance to ask, "Wait a minute, is this real?" But the true deception begins after you deposit your first few $100s. Within hours, you'll get a phone call. It won't be from a generic customer service agent. It will be from your personal account manager or senior analyst. Let's call him Mark. Mark will be the friendliest, most confident person you've ever spoken to. He'll congratulate you on taking the first step towards financial freedom. He'll tell you he's here to help you succeed. Mark's real job is not to help you trade. His real job is to make you deposit more money. He'll start by giving you a special tip. He'll say, "Listen, we're seeing a huge signal on the euro/dollar pair right now. Our big institutional clients are all going long. If you can deposit another $2,000, we can get you into a position with some real size. The trade might even be a small winner." This is part of the hook. They let you win a little at first to build your confidence and, more importantly, to build your trust in Mark. The next call will be more urgent. Your account is doing well, but it's too small to handle any real market news. The Federal Reserve is speaking this week. To protect your account from volatility, you need more margin. You should deposit another $5,000. Notice the language. It's not about profit, it's about fear. It's about protecting what you already have. This is a classic high-pressure sales tactic. And if you hesitate, they'll turn to emotional manipulation. Don't you want to build a better future for your family? This is a once-in-a-generation opportunity. You have to be bold. They are selling you a dream, and the price of that dream is another wire transfer. While this is happening on the phone, something else is happening on your screen. You think you're trading on the real market, but you're not. You're trading on a closed system, a simulation controlled entirely by the broker. This is often called a B-book model. A legitimate broker, an A-book broker, acts as an intermediary. They take your order and pass it through to the global interbank market. They make a small, transparent commission or a tiny markup on the spread, regardless of whether you win or lose. They have no stake in your trade's outcome. A scam B-book broker is the opposite. They are your counterparty. They take the other side of your bet. When you buy the euro, they are effectively selling it to you. If you win, they lose money directly from their own pocket. If you lose, your loss is their direct profit. They are the house in a casino, and they have every incentive in the world to make you lose. And since they control the platform, they can rig the game. When you see a great price and click buy, the price might suddenly jump against you before your order is filled. This is called slippage. When you have a winning trade and you try to close it, the platform might freeze, or the close button might become unresponsive until the price has moved against you. Or you'll get a requote at a much worse price. These aren't random glitches. They are features of the scam, designed to slowly bleed your account dry. The final act is the one that breaks people. You've either lost all your money to these manipulated trades, or you've actually managed to make some profit in their system. You decide it's time to cash out. You put in a withdrawal request for, say, $10,000, and then silence. You email support. No reply. You call your friendly account manager, Mark. His number is disconnected. A week later, you get an automated email. For security verification, we require a notarized copy of your passport, a utility bill from the last 30 days, and a photo of you holding your credit card. You scramble to send it all in. Another week of silence. Then another email. Your documents were not clear enough. Please resubmit. This can go on for months. They will invent an endless series of bureaucratic hurdles, each one designed to make you give up. Few persist, they'll invent a new rule. Due to international tax law, you must first pay a 20% transfer fee on your withdrawal amount. Please wire us $2,000, and we will release your $10,000. Of course, if you send that money, you will never see it or your original funds ever again. This is the anatomy of the trap. It's a sophisticated combination of jurisdictional arbitrage, psychological manipulation, and technological deceit. It's designed to look and feel like a legitimate investment, right up until the moment the cage door slams shut. So if that's the wild, unregulated jungle, what does the protected, regulated national park look like here in the United States? Who are the sheriffs that patrol this territory? And what specific laws and organizations are in place not just to punish the bad guys, but to prevent them from setting up shop in the first place? That's where the real power of the US system lies. This power is structured like a two-tiered fortress, designed to be almost impenetrable to the scammers and fly-by-night operations that plague other parts of the world. At the very top, you have the federal government's heavy artillery. This is the Commodity Futures Trading Commission, or the CFTC. Think of them as the architects and ultimate guardians of the fortress. They don't just write the rules. They have the full force of federal law behind them to bring down the hammer on anyone who dares to violate them. The CFTC was given its modern, formidable powers in the wake of the 2008 financial crisis through a sweeping piece of legislation we'll dissect in a moment called the Dodd-Frank Act. Their mandate is vast, covering all derivatives markets, which includes futures, options, and yes, the retail off-exchange Forex market we're talking about. They are the ones who decide what is and isn't allowed, setting the grand strategy for protecting American market participants. But the CFTC doesn't walk the beat every day. For that, they deputize a second, more hands-on organization. This is the National Futures Association, or the NFA. If the CFTC is the general, the NFA is the elite special forces unit on the ground. It's a self-regulatory organization, which means it's funded by the industry it oversees, but it operates under the direct authority of the CFTC. Every single firm and individual that wants to legally offer Forex trading services to U.S. residents must be registered with the CFTC and be a member of the NFA. There are no exceptions. This isn't a suggestion, it's the law. The NFA is the entity that conducts audits, vets applications, writes specific conduct rules, and runs a dispute resolution program. They are the gatekeepers. If a broker wants to do business in the US, they have to get past the NFA first. And that is incredibly difficult by design. So how did this fortress get built? The main blueprint, as I mentioned, is the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. This colossal piece of legislation was a direct response to the near collapse of the global financial system. Regulators looked at the chaos and said, "Never again." While most people associate Dodd-Frank with big banks, a specific section of it completely terraformed the landscape for retail forex trading in the United States. It took what was once a Wild West environment and turned it into one of the most strictly regulated markets on the planet. Let's start with the first and perhaps highest wall of the fortress, the capital requirement. Before Dodd-Frank, you could potentially start a forex brokerage with a relatively small amount of capital. This led to undercapitalized firms that could be wiped out by a single volatile market event, taking their clients' money with them. Dodd-Frank changed that overnight. Today, to be a registered retail foreign exchange dealer in the US, a broker must maintain adjusted net capital of at least $20 million. Let that sink in. $20 million. This isn't just money they need to have. It's a liquid capital cushion that must be maintained at all times to protect their clients from the broker's own potential losses or insolvency. This single rule instantly vaporized hundreds of smaller, less stable players from the US market. It acts as an enormous filter, ensuring that only the largest, most well-capitalized, and most serious financial institutions can even think about offering forex trading to US citizens. It's a multi-million-dollar barrier to entry that keeps the weak and the predatory out. Next, let's talk about one of the most controversial but crucial protections: leverage caps. Outside the US, it's common to see brokers offering insane leverage ratios, 500 to 1, 1,000 to 1, even 2,000 to 1. It sounds amazing, right? Control $100,000 with just 100 of your own. But this is a deadly trap for new traders. Extreme leverage magnifies losses just as much as it magnifies gains. A tiny market move against your position, we're talking fractions of a cent, can result in a total wipeout of your account. It turns trading into a casino bet. US regulators saw this as one of the single biggest dangers to retail traders. So they stepped in. In the US, leverage is capped at 50 to 1 for major currency pairs like the euro versus the dollar, and 20 to 1 for minor pairs. Now, a lot of people online complain about this. They say it limits their potential. But what it really does is install a safety mechanism. Think of it like a speed governor on a supercar. Yes, the car could theoretically go 250 miles per hour, but for a driver on a public road, that's a recipe for disaster. The governor, limiting it to a more sane speed, is there not to ruin your fun, but to prevent a catastrophic crash. The US leverage cap is a financial speed governor. It forces traders to use better risk management and prevents them from blowing up their accounts with a single bat trade fueled by excessive, dangerous leverage. It's a paternalistic rule for sure, but its intention is purely to protect the consumer from the single biggest risk in forex trading: themselves. But the US rules go even deeper, right down to how you can manage your trades. This brings us to two unique American regulations: the FIFO rule and the prohibition on hedging. FIFO stands for first in, first out. This is an accounting principle that, in the context of US Forex trading, means if you have multiple open positions on the same currency pair, you must close the oldest position first. You can't pick and choose to close the most profitable one while leaving older, losing trades open. For example, if you bought the euro to US dollar this morning, and then bought it again this afternoon, you are not allowed to sell the afternoon position until you have first closed out the morning position. Directly related to this is the no hedging rule. In the US, you cannot hold a long position and a short position on the same currency pair in the same account at the same time. You can't be both buying and selling the euro to US dollar simultaneously. In many other countries, hedging is a common strategy. So why did US regulators ban it? Their reasoning was twofold. First, they saw it as economically redundant. Being long and short the same asset at the same time results in a net position of zero. You're effectively frozen. You're not gaining or losing from market movements, but you are paying the transaction cost, the spread, on two separate positions. Brokers, of course, love this as they make money on both trades. Regulators viewed this as a way for brokers to generate commissions on a strategy that offered little to no real benefit to the retail trader, and often just created confusion. Second, by enforcing FIFO and banning hedging, they simplified the trading environment. It prevents complex and potentially misleading trading schemes and forces a clearer, more straightforward approach to risk. So you have this combination: a $20 million capital moat, a leverage speed governor, and strict traffic rules for how trades can be executed. What does this all mean for you, the person considering trading Forex in the US? It means you are operating in a tightly controlled ecosystem. It's a walled garden. While some might see the walls as restrictive, they are there to keep the predators out. The brokers who have survived and operate in this environment have proven they are substantial, serious financial firms. They've passed the NFA's scrutiny and have the capital to withstand market shocks. More importantly, this system gives you a powerful tool. Because every legitimate US broker must be registered, you can verify their status in seconds. The NFA maintains a public online database called BASIC, which stands for Background Affiliation Status Information Center. You can go to the NFA website, type in the name of any firm or individual claiming to offer Forex services, and instantly see their registration status, their regulatory history, and any disciplinary actions that have ever been taken against them. It's a background check at your fingertips. If a broker is not listed in that database, or if their status is not NFA member approved, they are operating illegally in the United States. Period. It's a simple binary test. This one tool alone is an incredibly powerful shield against the legions of offshore, unregulated brokers that solicit traders online. Before you even think about opening an account, you can perform your due diligence in less than a minute. This transparency is the bedrock of the US system. It replaces guesswork and trust with verifiable facts. The question then becomes, with such a robust fortress in place, how do the scams still happen? Where are the cracks in the wall? And what do the modern Forex scams that target Americans actually look like? They've had to evolve to get around these protections, and their methods are more insidious than you might imagine. The most insidious scams aren't the ones that knock on your front door. They're the ones that slide into your DMs. They don't look like a threat. They look like an opportunity. They look like a guy named Alex, standing in front of a rented Lamborghini, holding his phone up to his face on an Instagram story. He's talking about freedom. He's talking about how he quit his 9-to-5, how he travels the world, and how it's all thanks to a secret he discovered in the Forex market. He tells you he's not selling anything. He just wants to help a few dedicated people achieve the same. All you have to do is join his free Telegram group. This is the face of the modern Forex scam. It's not a shadowy figure in a boiler room. It's a charismatic guru or influencer building a parasocial relationship with thousands of followers. This is the first and perhaps most common evolution of the Forex scam targeting Americans today, the signal seller scheme. Here's how the playbook works. First, they build an image of incredible wealth and success. The luxury cars, the penthouse apartments, the trips to Dubai. It's all meticulously curated to trigger a powerful sense of FOMO, the fear of missing out. They create the impression that they possess knowledge that you don't, a key to a door you can't seem to find. Next, they offer a taste for free. That Telegram group or Discord server is the hook. Inside, they might post a few winning trade signals, telling you when to buy or sell a currency pair. Maybe one or two of them work out, netting you a small, thrilling profit on a demo account. This is a critical step. It builds trust and provides social proof. You see other people in the group celebrating their wins, thanking the guru. What you don't see are the losing trades they don't talk about, or the fact that many of those celebrating members might be fake accounts controlled by the scammer. Finally comes the upsell. The real secrets, the VIP signals. The ones that supposedly generate life-changing returns are locked behind a paywall. It could be a subscription, maybe $50, $100, or even $500 a month. They frame it as an investment in yourself. If you can't invest $100 to make thousands, you're not serious, they'll say. But here's the cold, hard reality of this model. The guru's primary business isn't trading Forex. Their business is selling subscriptions. The signals they provide are often generic, based on basic technical analysis that you could learn for free online. Sometimes they're just flat-out guesses. If they have 1,000 people in their group and they issue a signal, some will win and some will lose just by chance. The winners will post testimonials, and the losers will be told they executed the trade wrong, or that losses are part of the game. The guru's income isn't tied to the quality of their signals. It's tied to the number of monthly subscribers they can keep on the hook. They are not a trader. They are a marketer selling a dream. This scam is so effective because it exploits psychology, not a loophole in the law. It preys on the desire for a shortcut. But often, this guru scam is just the first layer of the onion. It's the gateway to an even more dangerous trap: the unregulated offshore broker. Remember those strict regulations we talked about? The CFTC and NFA registration, the leverage caps, the segregation of client funds? These rules exist to protect you. An unregulated broker, by definition, ignores all of them. The guru you trust will often tell you, to get the best results with my signals, you need to use the same broker I use. They have the best execution and higher leverage. They'll provide you with a special link. What they don't tell you is that they're getting a massive kickback, a commission, for every person they send to that broker. This broker will be based in a small island nation with lax financial laws, far beyond the reach of US regulators. When you land on their website, it looks professional. It has charts, graphs, and a slick user interface. They'll offer you things that US brokers legally cannot, like a 200% deposit bonus or 500-to-1 leverage. It feels like you're getting a special advantage. You're not. You're walking into a casino where the house not only has an edge, but they also own the deck, the table, and the exit doors. Once your money is with an unregulated broker, a number of things can happen, none of them good. The most common scenario is a slow bleed. You might notice strange slippage on your trades, where your order is filled at a much worse price than you expected. You might see sudden, bizarre price spikes on your chart, spikes that don't appear on any other legitimate data feed, that conveniently hit your stop loss and close your position for a loss. This is the platform being manipulated against you. The more brazen scenario is the refusal of withdrawals. You might make some profits and decide to cash out. First, they'll delay. They'll ask for more and more verification documents. They'll say there's a problem with their payment processor. They'll stop responding to your emails. They are waiting for you to either give up or, in a fit of frustration, lose the money by overtrading. In the worst-case scenario, the broker simply vanishes. The website goes down, the phone numbers are disconnected, and your money is gone forever. You have no recourse. You can't complain to the CFTC, because this entity was never under their jurisdiction. It's the digital equivalent of handing a suitcase full of cash to a stranger in a foreign country, and just hoping they'll give it back. This leads us to the third evolution of the modern scam, which often combines the first two: the fraudulent account manager or copy trading service. This one preys on people who want the potential rewards of Forex without putting in the time to learn. The pitch is incredibly seductive. You don't have to learn anything. Just deposit your funds and our team of expert, professional traders will trade on your behalf. We use a sophisticated strategy, and we only make money when you make money. They'll show you a track record of incredible, consistent gains. A spreadsheet of pure green. They'll ask you to deposit money, often with, you guessed it, a specific unregulated offshore broker they're partnered with. In the beginning, things might look great. Your account balance goes up. You see a history of winning trades. This is designed to build your confidence and encourage you to deposit more money. If you made $500 with a $1,000 investment, imagine what you could make with $10,000. Once they feel they've gotten as much money from you as they can, the endgame begins. They might start a practice called churning, where they open and close dozens of pointless trades just to generate commissions for themselves at your expense. Or they'll orchestrate a catastrophic loss. Suddenly, one or two incredibly high-risk trades will go wrong and wipe out your entire account balance. When you frantically contact them, they'll be very apologetic. The market was unusually volatile, they'll say. This has never happened before. Trading has inherent risks. They'll use the industry's own disclaimers against you. Your money is gone, and legally they're covered by the fine print you agreed to. The profits you saw earlier were likely never real in the first place. They were just numbers on a screen, manipulated to keep you hooked. These three scams, the guru, the unregulated broker, and the fraudulent account manager, form a toxic ecosystem. They feed into each other, creating a funnel that's designed to separate you from your money by exploiting trust, hope, and a lack of regulatory knowledge. They've evolved to bypass US protections by convincing you, the trader, to willingly step outside of that protected walled garden. They make you believe the real opportunity is out there, beyond the rules. But the truth is, the rules were built to protect you from what's out there. So these are the external threats, the human-led schemes designed to deceive. But what about a threat that's more automated, more insidious? What if the biggest risk isn't a charismatic scammer, but a legitimate-looking piece of software you willingly install on your own computer? This is the world of malicious trading robots and so-called expert advisors, and their danger can go far beyond just your trading account. They operate under a simple, intoxicating premise: What if you could remove the weakest link in every trading strategy? Yourself. What if you could eliminate fear, greed, and hesitation? What if a tireless, emotionless, code-based genius could analyze the markets for you? 24 hours a day, 5 days a week, executing trades with lightning speed and mathematical precision while you sleep, work, or spend time with your family. This is the siren song of the automated trading robot, the so-called expert advisor or EA. And it is, without a doubt, one of the most effective and devastating traps in the retail Forex landscape. The danger lies in its sophistication. This isn't a poorly worded email from a foreign prince. These operations have slick, professional websites. They feature video testimonials from people who look and sound just like you, raving about their newfound financial freedom. They present you with binders full of back-tested data, complex charts and spreadsheets that seem to prove, beyond a shadow of a doubt, that their software has consistently produced incredible returns for years. They might even offer a free trial or a money-back satisfaction period, lulling you into a false sense of security. You're not wiring money to a stranger. You're making a savvy investment in cutting-edge financial technology. Except you're not. Let's pull back the curtain on how these schemes actually work, because there are several flavors of poison. The most brazen and the most terrifying is the robot that is nothing more than a Trojan horse. It's malware, plain and simple. You pay your $200, $500, or even $1,000 for the software. You download it, run the installer, and link it to your trading platform, giving it permission to access your account. But the software has no intention of trading. Its real code is a keylogger, designed to record everything you type. Suddenly, the scammers don't just have your trading account login and password. They have the password to your email, the login for your online banking, your credit card numbers. They have the keys to your entire digital life. The money in your trading account was just the appetizer. Your entire financial identity is the main course. In this scenario, the EA didn't just blow up your account. It created a crater where your financial security used to be. A more subtle and far more common approach is what I call the churn and burn scheme. In this model, the robot actually trades. When you install it, you see it opening and closing positions. Feels real. The problem is, the robot's prime directive isn't to make you profitable. Its goal is to generate the maximum number of trades possible. It will open and close positions constantly, often for tiny gains or small losses. You might wonder, why would it do that? Because the scammer who sold you the robot has a secret partnership with a specific, often unregulated, offshore broker. The scammer gets a kickback, a commission, for every single trade you make. The robot isn't trading to make you money. It's trading to make the scammer and the broker money. It churns through your capital, with each trade acting like a small cut. The spread and commissions eat you alive. Your account balance slowly, steadily bleeds out, and you're left wondering why this hyper-advanced algorithm can't seem to make any headway. It was never designed to. It was designed to drain you one commission at a time. This is why many scammiers will insist you use their recommended broker. It's not a recommendation. It's a requirement for their scheme to work. Then there's the mirage of the demo account. This is a classic bait and switch. The scammer tells you to test their robot on a demo account first. They know you're cautious, so you do. You run the robot for a week, maybe two, and the results are breathtaking. It's a rocket ship of profits. The equity curve goes straight up. You're convinced you've found the holy grail. You eagerly deposit thousands of dollars of your real, hard-earned money into a live account, turn on the robot, and then it all falls apart. The robot starts taking disastrous trades, ignoring its own supposed rules and hemorrhaging money. What happened? The demo account was rigged. The scammer, often in collusion with the broker, was feeding the robot a perfect, simulated data stream designed to produce flawless results. The live market, with its unpredictable volatility and real-world execution speeds, is a completely different beast. The robot was never meant to survive in it. The perfect demo performance was a carefully constructed illusion, a marketing tool designed to do one thing: get you to fund a live account that it was programmed to destroy. So how do you protect yourself? How do you spot these predators before they get their claws into your capital? You have to learn to recognize the red flags, and they are almost always waving in plain sight. First, and most importantly, unrealistic profit claims. If a website or salesperson is talking about 99% win rates, doubling your account every month, or showing a MyFX book account that looks like a 45-degree straight line to the moon, run. Do not walk, run. Professional trading, even at the hedge fund level, is a game of inches, of managing risk and grinding out returns over time. It is full of wins and losses. Anyone selling a fantasy of effortless, guaranteed-style returns is not selling a trading tool. They are selling a lottery ticket that has already been torn in half. Second, look for a profound lack of transparency. Who are the developers? What is their track record? What is the underlying strategy of the robot? Is it a trend-following system? A mean reversion strategy? Scammers hide behind anonymity and vague technobabble about proprietary neural networks and AI-driven predictive analytics. Legitimate algorithmic developers, while they won't give away their secret sauce, can typically articulate the core logic of their system because they built it and understand it. If you can't find out who made it or how it works in principle, you should be extremely skeptical. Third, be wary of high-pressure sales tactics. Only 3 copies left at this price. This offer expires at midnight. Join our exclusive club of winners before it's too late. This language is designed to trigger a fear of missing out or FOMO, and to rush you into making a decision before your rational brain has time to engage and do proper research. A truly valuable product doesn't need to be sold with the urgency of a late-night infomercial. Fourth, understand the lie of the perfect backtest. Scammers will present you with a curve-fitted backtest. This means they've tweaked the robot's parameters to perform perfectly on a specific set of historical data, usually a period where the market was moving in a very favorable, easy-to-trade way. The moment you apply that robot to live market conditions that are even slightly different, its performance shatters. A robust system is tested across years of data, through bull markets, bear markets, and sideways chop. Asked to see results from difficult periods, like the 2008 financial crisis or the 2020 pandemic flash crash. Their refusal to provide them will tell you everything you need to know. Now, it is important to state that algorithmic trading itself is not a scam. It is the dominant force in the financial world. The largest and most successful hedge funds on the planet are quantitative, using incredibly complex algorithms to trade. And there are legitimate EAs available for retail traders. But they are sold as tools, not as magic money machines. They are sold with realistic disclaimers about risk. They are developed by transparent teams with a public presence. They are designed to assist a trader who understands the market, not to replace them. They are a scalpel, not a magic wand. The difference between a legitimate trading tool and a scam is the promise. One promises a potential edge if used correctly. The other promises a life of riches with the click of a button. The hunt for that magic button, that shortcut to success, is a powerful motivator. It leads people to trust in a piece of code they don't understand, sold by people they've never met. But even if you manage to avoid every scam artist and every malicious piece of software out there, you're still not safe. Because what if the biggest threat isn't a program you install, or a con artist you meet online? What if the most dangerous enemy to your trading account is the one staring back at you in the mirror? The world of Forex is littered with the ghosts of traders who fell victim not to a scam, but to their own psychology. And that is where the real battle is fought. This internal battlefield has 2 generals, 2 puppet masters who have controlled human decisions around money for centuries. Fear and greed. They are the invisible hands that move the mouse, that click buy or sell not based on a plan, but on a gut-wrenching impulse. And in the high-stakes, high-leverage world of Forex, these impulses are amplified 1,000 times over. Let me tell you about a trader we'll call Mike. Mike was smart. Ivy League education, great job in tech, saved up a solid $10,000 to start his trading account. He spent 6 months on a demo account practicing. He read all the books, he followed all the gurus, and he was profitable. Consistently. He felt ready. He believed he was immune to the emotional roller coaster he'd read about. That was for other people. The undisciplined. The gamblers. Not him. He funded his live account. The first week was electric. He followed his plan perfectly. He caught a nice move on the British pound against the dollar. A clean $700 profit. The next day, another $500 on the euro. The money felt different. It wasn't demo money anymore. This was real. He could withdraw it, buy something with it. The feeling was intoxicating. And that's when greed, that silent puppet master, first whispered in his ear. You see, Mike? You've got this. That 1% risk rule? That's for beginners. You're past that. You can handle more. Imagine if you had risked 3% on that last trade. That would have been $1,500, not $500. You could make your weekly salary in a single day. So, on his next trade, he did it. He tripled his position size. He saw a setup that looked almost identical to his last winner. He felt that same jolt of adrenaline, that certainty. He placed the trade. For a moment it went in his favor. He was up over $1,000. He could almost taste it. But then the market turned. A news headline flashed across the screen. Something unexpected out of the European Central Bank. The trade whipped against him hard and fast. In minutes, his $1,000 gain became a $2,000 loss. His stop-loss hit, and the trade was closed. Silence. Just the low hum of his computer. $2,000. Gone. That was a week's salary. More than all his previous profits combined. The feeling was sickening. A cold knot formed in his stomach. And now the other puppet master, fear, stepped out of the shadows. Fear didn't just whisper. It screamed. "You're a failure, Mike. You lost all that money. You'll never make it back. What were you thinking? You should just quit now before you lose everything." The next day he saw a perfect A+ setup according to his trading plan. But he hesitated. His hand hovered over the mouse. Fear held him paralyzed. What if you lose again? What if it turns against you just like the last one? He watched as the trade played out without him, moving exactly as he had predicted, a move that would have netted him back a good portion of his loss. The missed opportunity was almost more painful than the loss itself. This combination of regret and frustration created a toxic cocktail in his mind. He was angry. Angry at the market. Angry at himself. And that anger gave rise to the most destructive trading behavior of all. Revenge trading. He abandoned his plan entirely. He started jumping into random trades, trying to force a win to get his money back now. He saw the Japanese yen making a huge move and jumped in, terrified of missing out. FOMO. He was late to the party, buying at the very top, just as the early buyers were taking their profits. The market reversed and he was stopped out again. Another loss. He felt the market was mocking him. He started looking for information that confirmed his new desperate bias, that the yen had to go back up. He ignored all the technical signals, all the price action that screamed sell. This is confirmation bias, where you stop analyzing the market and start searching for opinions that justify your emotional decision. Within 2 weeks, Mike's $10,000 account had dwindled to less than $1,000. He sat there staring at the screen, completely broken. It wasn't a scam that took his money. It wasn't an unregulated broker from a remote island. It was a regulated US-based broker. The market was just being the market, volatile and unpredictable. The market didn't take Mike's money. Mike gave it to the market, one emotional decision at a time. Mike's story is not unique. It is the default path for the vast majority of aspiring traders. They prepare for a battle of charts and indicators, but they show up unarmed for a war against their own human nature. The legitimacy of the market is irrelevant if you are not legitimate with yourself. So how do you fight this internal enemy? How do you build the psychological fortress necessary to even stand a chance? It's not about finding a holy grail indicator or a secret strategy. It's about forging two critical pieces of armor: a non-negotiable trading plan and a brutally honest trading journal. Think of your trading plan as the constitution for your trading business. It is a document you create when you are sane, logical, and objective, to protect you from the person you become when you are emotional, fearful, or greedy. This plan is not just buy here, sell there. It must be ruthlessly specific. What exact market conditions constitute a valid entry signal for your strategy? What is your precise position size for every single trade, calculated based on a fixed percentage of your capital, like 1%? Where will your stop-loss order be placed the instant you enter a trade, defining your maximum acceptable loss? And just as important, what are your rules for taking profit? Your plan must also have rules for you, the operator. What will you do after 3 consecutive losses? Most professional plans mandate a mandatory break. Shut down the computer and walk away for the rest of the day. What will you do after a huge, unexpected win? The plan should say, stick to the rules, don't increase your risk. Greed is just as dangerous as fear. This plan is your shield. It deflects the emotional arrows of FOMO and revenge trading. When you feel the urge to break your rules, you look at the plan. It is your commitment to yourself, your promise to trade like a professional, not a gambler. The second piece of armor is your trading journal. This is your sword, the tool you use to learn and adapt. A journal is not just a spreadsheet of your wins and losses. That's a trade log. A true journal captures your psychological state. For every trade you write down, why did I take this trade? What was my emotional state? Was I calm and objective, or was I anxious and trying to force something? If the trade was a loser, Did I follow my plan exactly? If not, why? If it was a winner, was it because I got lucky or because I executed my plan flawlessly? Week after week, you review this journal, and patterns will emerge. You might discover that you lose the most money on Friday afternoons, or that after a big loss, your next 5 trades are always impulsive. The journal exposes your weaknesses. It puts a spotlight on the tricks your own mind is playing on you. It is a tool for radical self-awareness, and in the world of trading, self-awareness is the ultimate edge. Without this armor, you are walking into the forex market naked. It doesn't matter how legitimate the broker is, or how regulated the environment is. The market is an arena designed to exploit human emotion. It will test your discipline, prey on your fear, and tempt your greed at every turn. Mastering the psychological game doesn't mean you'll never feel fear or greed. It means you build a system of rules and discipline so robust that those feelings no longer have control over your actions. So you've begun to forge your internal armor. You understand the psychological war that must be won. But this is only half the equation. Now you must turn your attention to the external world. You have to choose your tools, your platform, your broker, the gateway through which you will access this global battlefield. And in the United States, choosing the right broker is a far more complex and critical decision than most people realize. Because not all brokers are created equal, and the wrong choice can undermine even the most disciplined trader. So, how do you navigate this minefield? How do you separate the legitimate partners from the digital predators? It starts by understanding that the United States isn't the Wild West of Forex. It's a fortress with high walls and heavily armed guards. These guards are 2 acronyms you absolutely must burn into your memory: the CFTC and the NFA. Think of the Commodity Futures Trading Commission, the CFTC, as the federal government's sheriff. They are the top-level regulator, an independent agency of the US government that was created to protect the public from fraud, manipulation, and abusive practices related to the sale of commodity and financial futures and options. They write the big, overarching rules of the game. They are the architects of the fortress walls. Then you have the National Futures Association, the NFA. If the CFTC is the sheriff, the NFA is the town's most respected deputy, the one who walks the beat every single day. The NFA is the nationwide, self-regulatory organization for the U.S. derivatives industry. They are the ones who handle the day-to-day enforcement, the registration of brokers, and the arbitration of disputes. They make sure everyone inside the fortress is following the sheriff's rules. Any broker wanting to legally operate in the United States and serve U.S. clients must be registered with the CFTC and be a member of the NFA. This is not a suggestion. It is not a nice-to-have. It is a non-negotiable, ironclad requirement. So, your first step before you even look at their spreads, their platforms, or their marketing is to play detective. Go to the NFA's website and look for their verification system. It's called BASIC, which stands for Background Affiliation Status Information Center. It's a public database, and it's your single most powerful tool. You can type in the name of any firm or individual, and it will tell you instantly if they are a registered NFA member in good standing. It will show you their regulatory history, any disciplinary actions taken against them, and their current status. If a broker you're considering isn't listed there, or if their status is anything but approved, you close the browser tab and you walk away. Period. There is no second question. This simple check can save you from 99% of the scams out there targeting US traders. But getting past the gatekeepers is only the first step. Once you're inside the fortress, you have to play by a unique set of American rules. This is where many aspiring traders get confused, especially if they've been watching videos or reading forums dominated by traders from Europe or Asia. The US Forex market operates under 2 major restrictions that you won't find in most other parts of the world. The first is the leverage cap. Following the 2008 financial crisis, the Dodd-Frank Act brought sweeping reforms to the financial industry, and Forex was right in its sights. The result was a rule that caps the maximum leverage US brokers can offer to their retail clients at 50-1 on major currency pairs and 20-1 on minor pairs. Now, you might see offshore brokers advertising insane leverage of 500-1, 1,000-1, or even higher. It seems tempting, right? Feels like you're being given a superpower. But it's a double-edged sword of the highest order. While high leverage can magnify potential gains, it magnifies potential losses just as viciously. A tiny market move against your position can result in a total wipeout of your account in seconds. The US regulators saw this as an unacceptable risk for retail traders. They essentially decided to replace a potential rocket ship that frequently explodes on the launch pad with a more reliable, albeit slower vehicle. The 50-to-1 cap is a safety measure. It's a seatbelt and an airbag, designed to protect you from catastrophic financial injury. The second uniquely American rule is even more controversial among traders, the FIFO rule. First in, first out. This rule sounds simple, but its implications are massive. It dictates that if you have multiple open positions on the same currency pair, you must close them in the order you opened them. Let's say you buy one lot of the euro versus the US dollar on Monday. On Tuesday, the price drops and you decide to buy another lot at a better price. On Wednesday, the price shoots up, and you want to take profit on that second, more profitable position you opened on Tuesday. You can't. The FIFO rule mandates that you must close the first position you opened on Monday before you are allowed to close the second one. This rule effectively eliminates two very common trading strategies used elsewhere in the world. The first is hedging. Hedging, in this context, is when a trader holds both a long buy and a short sell position on the same currency pair at the same time, often to temporarily protect against adverse market moves without closing the original position. In the US, this is impossible. The moment you try to open an opposing position, the system will simply net it out against your existing one. The second strategy it impacts is scaling out of positions in a non-sequential order. As in our example, you can't pick and choose which of your profitable trades to close first. You are locked into the sequence of entry. For some trading systems, this is a deal breaker. For others, it's just a constraint to be worked around. But either way, you have to know it exists. Understanding the regulatory landscape and the unique rules is your foundation. Now, we can talk about the brokers themselves. And to do that, you have to understand the fundamental difference in how they make money, which typically falls into two categories: the dealing desk broker and the no-dealing desk broker. A dealing desk broker is also known as a market maker. As the name implies, they make a market for their clients. When you place a trade, you are not trading directly with the interbank market. You are trading against your broker. They take the other side of your position. If you buy, they sell to you. If you sell, they buy from you. They make money primarily from the spread, the difference between the buy and sell price. Now, this creates a potential conflict of interest that you need to be aware of. Since they are the counterparty to your trade, in the simplest terms, your loss is their gain and your gain is their loss. Reputable market makers manage this risk through complex hedging strategies and by matching trades internally between their clients. They provide a service by offering fixed spreads and guaranteed liquidity, which can be very appealing for beginners. On the other side, you have no dealing desk or NDD brokers. These brokers act as a bridge rather than a counterparty. They pass your orders directly through to liquidity providers, which could be major banks, other financial institutions, or even other traders. There are two main types of NDD brokers: STP and ECN. An STP, or straight-through processing, broker routes your order to one of its liquidity providers and usually makes money by adding a small, often invisible markup to the spread. An ECN, or electronic communication network, broker creates a live, auction-style marketplace. They put your order into a network where it interacts directly with orders from all other market participants. This model is often praised for its transparency. You get to see the raw market prices. ECN brokers don't profit from the spread. Instead, they charge a small, fixed commission on each trade you make. So which one is better? It's not about better or worse. It's about what fits your needs. A dealing desk might offer a simpler experience with predictable, fixed spreads. An ECN broker might offer tighter variable spreads and more transparency, which could be beneficial for larger, more frequent traders, but you have to factor in the commission costs. The key is to know what model a broker uses. A trustworthy broker will be transparent about this. They will state clearly on their website whether they are a market maker, an STP broker, or an ECN broker. If you have to dig through pages of legal documents to find this information, that itself is a red flag. This choice between regulated market models is a strategic one. But the choice to use an unregulated offshore entity promising you the moon? That isn't a strategy. That's a gamble where the house has rigged the game from the very beginning. Your first and most important trade is not in the market itself. It's in the careful, diligent selection of the regulated partner who will give you access to it. So, how do you find that partner? How do you separate the legitimate, regulated professionals from the digital pirates sailing the high seas of the internet, flying a skull and crossbones disguised as a logo? In the United States, the answer is surprisingly clear, because the map to safety has already been drawn for you by two very powerful and very serious organizations, the Commodity Futures Trading Commission or CFTC, and the National Futures Association or NFA. Think of the CFTC as the federal government's financial sheriff. They are the law. They set the big rules, hunt down the bad actors, and have the power to bring the full weight of the US government down on anyone who breaks federal commodities laws. They are the reason the Forex landscape in the US looks so different from the rest of the world. Then you have the NFA. If the CFTC is the sheriff, the NFA is the hypervigilant deputy that patrols the streets every single day. It's a self-regulatory organization, which means it's tasked by the industry, under the watchful eye of the CFTC, to maintain the integrity of the derivatives markets. Every single firm and individual that wants to legally offer Forex trading services to US retail clients must be registered with the CFTC and be a member of the NFA. There are no exceptions, no loopholes. This isn't a suggestion. It's the absolute bedrock law of the land. Any broker that wants your business must meet a daunting list of requirements designed for one primary purpose: to protect you, the trader. So let's build the ultimate checklist. The non-negotiables. The things you must verify before you even think about depositing a single dollar. First, and most importantly, you must verify their registration and membership status. Don't just take their word for it. Don't just look for a fancy logo on their website. You need to become a detective for 5 minutes. The NFA has a free public tool called BASIC, which stands for Background Affiliation Status Information Center. You can simply search for the broker's name or their NFA ID number. The report will tell you in black and white if they are an NFA member and if they are legally authorized to deal with US customers. It will also show you their regulatory history, including any disciplinary actions. If a broker is not listed here, or if their status is not active and approved, you close the browser tab and you never look back. It's that simple. Second, look at their capital. The CFTC mandates that US Forex brokers maintain a minimum of $20 million in net capital. $20 million. Why? Because this isn't a business you can run from a garage. This capital requirement acts as a massive financial cushion. It demonstrates that the broker is a serious, substantial enterprise that can meet its financial obligations to its customers, even during periods of extreme market volatility. It's a buffer that protects you from a broker's operational failures. An undercapitalized offshore broker might go belly up from a flash crash, taking your funds with them. A properly capitalized US broker is built to withstand those storms. Third, and this is a concept that every trader needs to understand, is the principle of segregated accounts. In the United States, regulated brokers are required by law to hold all client funds in accounts that are separate from the firm's own operational funds. This is a monumental protection. It means the money you deposit is not the broker's money. They can't use it to pay their rent, their salaries, or their marketing budget. Your money is ring-fenced, protected from the broker's creditors if they were to face financial difficulty. In the unregulated world, your deposit often just goes into the company's bank account. If they go bankrupt, you become just another creditor in a long line, with little hope of ever seeing your money again. With a regulated US broker, your funds are accounted for separately, which is a critical layer of security. Now that we know what to look for, it's just as important to know the giant, flashing red flags that scream "stay away." These are the siren songs of the unregulated market, designed to lure you onto the rocks. The first and biggest red flag is a broker based offshore that actively solicits US clients. If their headquarters are in a small island nation and they don't have that critical NFA membership, they are operating outside of US law. They have chosen to not submit to the jurisdiction and protections that we've just discussed. Why would they do that? The answer is almost never in your favor. The second red flag is the offer of insane leverage. You'll see ads for 500 to 1, 1,000 to 1, even 2,000 to 1 leverage. This is illegal for US retail clients. The CFTC has capped leverage at 50 to 1 for major currency pairs and 20 to 1 for all others. This wasn't done to limit your potential. It was done to protect you from catastrophic account-destroying risk. High leverage is a double-edged sword that cuts novice traders to pieces. It magnifies losses just as much as it magnifies gains. Offering illegal leverage is a marketing gimmick used by offshore brokers to attract thrill seekers, not to build a sustainable trading environment. They know that with such high leverage, the vast majority of traders will blow up their accounts quickly, and that money goes directly into the broker's pocket. The third red flag is pressure. High-pressure sales tactics. Constant phone calls from an account manager or a senior analyst who promises to help you. Let's be crystal clear. These are not your friends. They are not hedge fund gurus who have decided to dedicate their lives to your success. They are salespeople often working on commission. Their job is to get you to deposit more money and to trade more frequently, generating commissions or spreads for the firm, regardless of whether those trades are good for you. A legitimate, regulated US broker will provide customer support, but they will not have a team of people cold calling you, pressuring you to deposit funds, or giving you unsolicited trading advice. They provide a platform you make the decisions. Imagine a new trader will call Mark. He's excited. He sees an online ad for a broker promising a 100% deposit bonus and 1,000-to-1 leverage. The website looks professional. They're based in a place he's never heard of, but he figures, it's the internet, it's all global now. He ignores the NFA and CFTC, which he's vaguely heard of, because the bonus is just too good to pass up. He deposits $5,000. His account manager, David, calls him daily, telling him about can't-miss trades. Mark's account balance soars, at least on paper. He feels like a genius. Then, he decides to withdraw some of his profits. He puts in a request. Nothing happens. He emails support. No reply. He calls David, but the number is disconnected. Suddenly, he can't log into his account. The website is gone. His $5,000 and all his paper profits have vanished into the digital ether. Mark didn't lose his money to the market. He lost it the moment he chose an unregulated partner. He wasn't trading. He was the target of a sophisticated scam. This story plays out every single day. The regulatory framework in the United States, with the CFTC and NFA as its guardians, was built specifically to prevent stories like Mark's. The rules aren't obstacles. They are armor. They are the moat, the high walls, and the vigilant watchtower protecting your capital from the predators that roam the financial wilderness. Choosing a broker isn't just the first step in your trading journey. It is the foundation upon which the entire structure is built. Choosing an unregulated, offshore entity is like deciding to build a skyscraper on a foundation of sand in the middle of a hurricane. It's not a question of if it will collapse, but when. So how do you find the bedrock? How do you distinguish the legitimate, regulated fortress from the cardboard cutout designed to collapse the moment you step inside? It comes down to a process of verification, a due diligence checklist that you must treat as non-negotiable. This isn't the exciting part of trading. It isn't drawing lines on a chart or predicting the next big move in the euro. But it is, without a shadow of a doubt, the most important trade you will ever make. Your first and most critical stop is a website that every single person considering Forex trading in the United States needs to bookmark. It's run by the National Futures Association, or NFA, and it's called BASIC. That's an acronym for Background Affiliation Status Information Center. Think of it as the FBI's most wanted list and the Better Business Bureau rolled into one, specifically for the financial futures and Forex industry. It is the ultimate source of truth. When a broker tells you they are regulated in the USA, they are saying they are registered with the NFA and the CFTC. You don't take their word for it. You verify it. You go to the NFA Basic search page, and you type in the firm's name or their NFA ID number. What you're looking for is a clean bill of health. The results will tell you in black and white if the firm is an NFA member. It will say yes right next to NFA member. It will list their current status. If it says anything other than registered and member, you close the tab and you never look back. But it goes deeper. The basic system will also show you any regulatory actions or disciplinary history. Has this firm been fined for misleading marketing? Have they been cited for poor record-keeping or for failing to uphold their financial requirements? This is all public information. A firm might be registered, but have a rap sheet a mile long. That's a massive red flag. It's like hiring a babysitter who has a valid driver's license, but you find out they have a history of speeding tickets and reckless driving. The license is the bare minimum. Their history tells you the real story. Spending 10 minutes on this one website can save you from months or even years of financial heartache. If a broker is not listed here, or if you can't find them, they are not legally allowed to offer Forex trading to US retail clients. Full stop. It's a simple binary test, and it's the first gate you must pass through. The second layer of your verification process involves the Commodity Futures Trading Commission, the CFTC. The CFTC is the federal government agency that has ultimate oversight. While the NFA handles the day-to-day regulation and member conduct, the CFTC is the top cop. They step in on major enforcement actions. You can also search the CFTC's website for actions taken against a firm. If a broker has been involved in a major fraud case or a significant market manipulation scheme, the CFTC is the agency that would have brought the hammer down. Cross-referencing between the NFA and CFTC databases gives you a comprehensive picture of a broker's regulatory standing. But regulation, as critical as it is only part of the puzzle. A broker can be fully regulated and still offer a terrible trading experience. This is where your due diligence has to evolve from a background check into a full-blown investigation. You need to become a private detective, and your subject is the company you're about to entrust with your hard-earned capital. Start with their reputation. Dive into reputable, independent online communities. I'm not talking about the flashy review sites where every broker has 5 stars, posted by accounts with only 1 review to their name. I'm talking about the trenches, places like the forums on Forex Factory, or dedicated subreddits where real traders share real experiences, warts and all. Look for patterns. Is there one person complaining? That could be a fluke, or a disgruntled trader who lost money on a bad trade and wants someone to blame. But are there 10, 20, 50 people all describing the same issue? Are they all complaining about a platform that freezes during major news events? Are they all talking about experiencing unusual and costly slippage on their trades? Are multiple people sharing stories of their withdrawal requests being delayed for weeks with flimsy excuses? That's not a fluke. That's a pattern. That's a red flag the size of a football field. Next, you have to scrutinize their trading conditions. This is the fine print that determines how much of your potential profit you actually get to keep. First, look at the spreads. The spread is the tiny difference between the buy price and the sell price of a currency pair, and it's how most brokers make their money. A broker with consistently wide spreads is taking a larger chunk out of every single trade you make, which can devastate a short-term trading strategy. Then there are commissions. Some brokers offer very tight spreads but charge a fixed commission per trade. There's nothing inherently wrong with this model, but you need to do the math. Calculate the total round-trip cost, the spread plus the commission, to understand what you're really paying. And critically, you need to understand their execution model. How do they fill your orders? When you click buy, what actually happens behind the scenes? Are they a true ECN or STP broker, passing your order directly to a network of liquidity providers to get you the best available price? Or are they a market maker, which means they are often taking the other side of your trade? In a market maker model, your loss is potentially their gain. Now, being a market maker isn't illegal or necessarily bad. Many reputable firms are, but it creates a potential conflict of interest that you need to be aware of. The most reputable brokers are transparent about their execution model. If you have to dig through pages of legal documents to figure it out, or if their customer service can't give you a straight answer, consider it another red flag. This brings us to the ultimate litmus test: their customer support. Before you even think about depositing $1,000 or even $100, test them. Send them an email with a detailed question about their order execution policy. Start a live chat and ask them to explain their withdrawal procedure and associated fees. And most importantly, call them. Is there even a phone number for US clients? When you call, does a real, knowledgeable human being answer? Or do you get stuck in an endless automated phone tree that routes you to a call center on the other side of the world? The quality of their support before you are a client is the absolute best-case scenario. It will only get worse once they have your money. If they are slow, unhelpful, or evasive when you're a potential customer, imagine how they'll treat you when you're trying to resolve a trade dispute or withdraw a large sum of money. A broker with poor, inaccessible customer service is a business that does not value its clients. It's a business that sees you not as a partner, but as a source of revenue to be squeezed. So let's recap the red flags. The absolute deal breakers. Unsolicited contact. If a broker slides into your Instagram DMs or cold calls you promising riches, it's a scam. High-pressure sales tactics. You have to deposit now to get this special bonus. That's the signature of a boiler room, not a financial institution. Guarantees of profit, as we've covered, this is the #1 sign of fraud. Vague claims about regulation. If they can't give you their NFA ID number instantly, they don't have one. And finally, any friction in the withdrawal process. A great way to test this is to make a small initial deposit, take a few trades, make a small profit, and then request to withdraw that profit. The process should be smooth, fast, and professional. If they stall, if they ask for excessive new documentation they didn't require for the deposit, if they simply ignore your request, get your initial deposit out immediately if you can, and never look back. Choosing a broker is not a one-time decision you make in 5 minutes. It's a foundational process. You are, in essence, hiring a company to be the custodian of your capital and your partner in one of the most competitive arenas on earth. You wouldn't hire an employee without checking their resume and references. Don't hire a broker without doing the same. By following this framework, verifying with the NFA, investigating their reputation, scrutinizing their trading conditions, and testing their support, you move from being a potential victim to being an informed consumer. You build your house on the bedrock of regulation and transparency. You've now built your fortress on solid ground. You've vetted the gatekeepers and ensured your capital is held with a legitimate, regulated entity. But now the gates are open, and you're looking out at the battlefield of the market itself. The external threats from scam brokers have been neutralized, but a new set of challenges emerges. How do you protect yourself not just from a bad broker, but from the volatility of the market? And even more critically, how do you protect your capital from the single greatest threat to any trader's account? Yourself? This is the paradox of trading. The market is an external force, a sea of numbers and charts, but the battle is almost entirely internal. Your own mind, hardwired for survival with fight-or-flight responses, is fundamentally unsuited for the cold, probabilistic world of financial markets. Greed, fear, hope, and despair. These are the emotions that turn a sound strategy into a losing account. Let's break it down. Greed makes you over-leverage, risking a huge portion of your capital on one sure thing. It convinces you to hold a winning trade far past your target, hoping for a little more, only to watch it reverse and turn into a loss. Fear is its opposite. It makes you cut your winners short, grabbing a tiny profit because you're scared of giving it back. It paralyzes you, making you miss a perfect setup your strategy screamed to take, and then you watch it run without you. And then there are the two most destructive behaviors: FOMO, the fear of missing out, and revenge trading. FOMO is that frantic feeling you get when you see a currency pair skyrocketing. You weren't in the trade, so you jump in late, right at the top, just as the early buyers are taking their profits. You effectively become their exit liquidity. Revenge trading is even worse. After a loss, you feel the market owes you. You jump right back in, angry, with a bigger position size to win it back. This isn't trading. It's gambling with a vendetta, and it almost never ends well. So how do you combat an enemy that lives inside your own head? You don't fight it. You constrain it. You build a system of rules so rigid, so objective, that it leaves no room for emotion to take the wheel. This system is called a trading plan. It is the single most important document you will ever create as a trader, more important than any indicator or software. A proper trading plan is your personal constitution. First, it defines your strategy. What exactly constitutes a valid trade setup? You need to write it down with the precision of a computer program. If indicator A crosses above line B, and the price is above the 200-period moving average, and the candlestick pattern is a bullish engulfing, then I will consider a long position. It must be a clear, repeatable set of conditions. No ambiguity. No, it feels right. Second, and most critically, is your risk management protocol. This is your ultimate defense. The most common rule among disciplined traders is the 1% rule. It means you will never risk more than 1% of your total account balance on a single trade. If you have a $10,000 account, your maximum acceptable loss on any given trade is $100. This isn't just a suggestion. It's a law. Following this rule makes it mathematically very difficult to blow up your account. A string of 10 consecutive losses, which will happen, would only reduce your account by about 10%, not wipe it out. Your plan must also have explicit exit rules. Before you even click the buy or sell button, you must know 3 things: your entry price, your stop-loss price, and your take-profit price. The stop-loss is your predetermined point of surrender. It's the price at which your trade is proven wrong, and you automatically exit with a small, manageable loss. The take-profit is your target. Once the price hits it, you exit the trade and lock in your gains. By defining these levels beforehand, you prevent in-the-moment emotion from making decisions for you. Finally, a trading plan involves meticulous record-keeping. Every single trade must be logged in a journal. The date, the currency pair, the entry, the stop, the profit target, the reason you took the trade, and the eventual outcome. You should also log your emotional state. Were you calm, anxious, overconfident? This journal is your data. It's how you identify your weaknesses, refine your strategy, and treat your trading like the serious business it is, not a trip to the casino. This brings us back to the central question. Is Forex legit? Yes, in the United States, the market itself is a legitimate, regulated financial arena. But the legitimacy of the market is completely separate from your ability to be profitable in it. The NBA is a legitimate professional sports league, but that doesn't mean you can step on the court and compete with LeBron James. The legitimacy of the arena has no bearing on the skill of the participant. Your success isn't determined by the market's legality. It's determined by your discipline, your risk management, your psychological fortitude, and your unwavering commitment to your trading plan. The statistics are sobering for a reason. The vast majority of retail traders fail not because Forex is a scam, but because they fail to manage their risk and their emotions. They treat it like a lottery ticket instead of a profession that demands the same rigor as being a pilot, a surgeon, or an engineer. And speaking of treating it like a business, there's one final crucial piece of the puzzle for US traders: taxes. This is often an afterthought for beginners, but it's a reality that can have significant financial consequences. It's essential to understand that any profits you make from Forex trading are taxable income. The IRS is not your trading partner, but they will take their share of the winnings. In the US, Forex taxation can be complex. Most retail Forex contracts fall under Section 988 of the tax code, where gains and losses are treated as ordinary income or loss, taxed at your regular income tax rate. However, traders may have the option to elect for Section 1256 contract treatment before the start of the year. This subjects your net gain to a potentially more favorable tax rate. 60% is taxed at the long-term capital gains rate, and 40% is taxed at the short-term rate, regardless of how long you held the position. This is known as the 60-40 rule. Now, this is a very simplified overview, and I must be crystal clear: this is not tax advice. The rules are nuanced, and your personal situation matters. Failing to report your gains or improperly filing can lead to serious penalties. Before you ever place a trade with real money, it is imperative that you consult with a qualified tax professional who has experience with trader tax status and these specific IRS code sections. They can provide guidance tailored to your circumstances. So, as we wrap up this journey, let's put it all together. We started by asking if Forex is legit. We discovered that yes, it is, provided you operate within the regulated ecosystem of the US, choosing brokers overseen by the NFA and CFTC. We learned to spot the red flags of offshore, unregulated brokers, and the siren song of unrealistic promises. We explored the immense power of leverage, a double-edged sword that must be wielded with extreme caution. But most importantly, we've learned that the greatest hurdles aren't external. They are not the brokers or the charts. The greatest challenge is mastering the internal landscape of your own mind. It's about replacing impulsive, emotional decisions with a cold, calculated, and disciplined process. It's about understanding that trading is a marathon of 1,000 small, well-managed trades, not a sprint to a single jackpot. It's a journey of continuous learning, self-analysis, and brutal honesty. The question was never really, is Forex trading legit in the USA? The market is just a venue. A more telling question is, are my expectations legitimate? Is my approach to risk legitimate? Is my commitment to education and discipline legitimate? The final question you have to ask is not about the market at all. It's about you. Are you willing to do the work, to build the plan, to cultivate the discipline, and to respect the risk required to become a legitimate trader? That answer is the only one that truly matters.